In this homework problem, we're going to go over how to calculate interest. It says on November 1st, Sather Sales Incorporated purchased inventory that cost $545,000, and they signed a 5-month trade note payable. The note carries an annual rate of interest of 2%, and the company has a December 31st year-end for their financial statements. The company uses a perpetual inventory system. So in requirement letter A, it says, what is the interest expense during the year? And the next question is, what is the interest expense the following year? So we can pull up the calculator, and if you notice the date, so year end is on December 31st. The company signed this note payable on November 1st. So for year end, how many months of interest should we recognize as interest expense? Count November, you count December, so 2. So 2 out of 12 months times the interest rate, so convert that to a decimal, 0.02, times the principal. So we're using the interest formula, interest equals principal times rate times time, and the time was 2 out of the 12 months. So times the principal, 545,000. That gives us 1817 because it says round to the nearest dollar. The next question, how much interest expense should be recognized the following year? Well, it's a 5-month trade note payable, and in the current year we recognize 2 months. So the following year we're going to recognize 3 months. So 3 out of 12 times, convert that to a decimal for the rate, times the principal, 2725. Oh, I think, let me do that again. So 3 out of 12 times 0.02 times 545. Okay. So I had put a typo there. I put 2726. All right. So now we just got to do the journal entries that go along with this transaction. So purchased inventory. So inventory goes on in the journal as a debit. It's an asset. And the note payable is a liability. That's a credit. It goes up by the same amount. Accrued interest at year end, this is the 1718 or the 1817 amount, interest expense, interest payable. Okay, and then the last one, oops, it says prepare the journal entry to record the payment of the trade notes payable. So the notes payable is going to go down because this is actually paying it. The interest payable that we accrued here will go down because, again, we are paying it. We've got to recognize the interest expense for the following year. So that is 2725. And then last is our cash, the cash amount that is being paid. So that's the 545 principal plus the 1817 interest that was accrued for the first year and the interest that was accrued the following year, okay, for this year. So the total cash that we're paying back for this equipment is $549,542. For this question, it is an unearned revenue question. Specifically, it's an insurance policy. So on May 1st of the current year, Manny Home and Casualty collected $576,000 for a 3-year insurance policy. and they have a December 31 year end. So requirement letter A, prepare the journal entries required on the date Manny collects the insurance premiums. So we are the insurance company. We're collecting $576,000 for 3-year insurance policies. So the journal entry would be cash is going up. That's a debit. It's an asset. And unearned insurance revenue, that's a liability, because now, Manny, that's who we are, we have an obligation to provide insurance coverage for a period of 3 years. So that's a liability going up. That's a credit, $576,000. All right, letter B, prepare the year-end adjusting entry for the current year. Well, let's find out how much the insurance policies are for each month. So the total was $576 for 3 years. So let's divide that by 36 months, which is 3 years. That gives us $16,000. So we are going to earn $16,000 every month because our customers are using this insurance policy. So for the current year, we collected the money on May 1, so insurance started on May 1, and now it's December 31st. So how many months of insurance have we earned? How much of that revenue have we earned? So from May, count the months from May to December, that should be 8 months. So say 16,000 times 8 months. And the amount is $128,000. So unearned insurance revenue goes down. Liability going down is a debit. Insurance revenue is a revenue account, so that is a credit. That goes up. So for the next two, it says record the same thing. Record how much insurance revenue we have earned for year 2 and year 3. Well, it was for 3 years, so that was 8 months. Okay, so all 12 months we've earned here. So 16,000 times 12 months, 192,000 for year 2 and 192,000 for year 3. Because remember, the total insurance coverage was 36 months. Okay, we had, I'm going to subtract 8. That was year 1. And then I'm going to subtract 12 months for year 2 here, and another 12 for year 3. So how many months do we have left for year 4? We have 4 months left. So for year 4, you would do 4 times 16,000, that monthly insurance amount. That gives us 64,000. So we've applied the 576, we've spread that over a total of 4 years, and it's because we received the money on May 1. Okay, if we had received the money on January 1, we would just have 3 journal entries of 192. But again, you got to look at your dates. These are all examples of good adjusting journal entries. Okay. This question 3, this problem is about gift cards and gift cards that are redeemed. So we know that gift cards are unearned revenue. So Feathered Depot sold $57,150 of gift cards during the current year and received cash. Feathered uses the proportional method for accounting for gift card breakage. Gift card breakage is an estimate of how much money will not be redeemed. So in other words, we always get gift cards and hopefully we always keep up with them, but there's a risk that you lose them. And this happens all the time. So that money to the company ends up being revenue if they don't redeem them. So based on historical experience, it estimates a breakage percent of 6% of its gift card sales. So the first journal entry, we're recording the amount of cash received, $57,150, and unearned revenue, a liability going up, that's a credit, $57,150. Over here to the side, it gives you additional information. During the year, customers redeemed $46,400 of gift cards, purchasing inventory that cost $28,100. And it says that the company uses perpetual inventory system. So now we are here. It says prepare the journal entry when the gift cards are redeemed. Do not record the expense. It's talking about the cost of goods sold right here. Don't record the expense related to the sale. We'll do that in the following step. So the gift cards redeemed, so the liability goes down $46,400 and sales revenue goes up because now, we have earned that money because we've sold them inventory or product. Next journal entry is recognizing cost of goods sold and decreasing the amount of our inventory because of these sales. So cost of goods sold, remember that is an expense account. That's a debit going up $28,100. Inventory and asset going down is a credit, $28,100. Okay. Now this next one is the one where this is new information down here. This is something that we did not do in 120 or 180. So I'm going to pull up and show you the work, the solution. All right, the first thing that you have to calculate in order to get this dollar amount is find out the breakage. And they give us the percent. That percent is based off the past. It's based off historical data or past trends. So it says prepare the journal entry to record the breakage revenue. It estimates a breakage percent of 6%. So take the amount of the gift cards that were originally purchased, the amount of the liability, $57,150, and multiply that by 0.06. Convert that percent into a decimal, and you get the estimated total breakage. Well, we have redeemed, or customers have redeemed some of these gift cards, so that needs to play into the equation as well. So let's find out what the percent of the gift cards redeemed really is. So you're taking the amount that it has been redeemed, the $46,400, and you're going to divide that. That's going to be your numerator over the amount of the gift cards sold, $57,150, minus the breakage that we calculated in step 1, and we get a percent. So that is the percent of gift cards that were redeemed. We're calculating a percent. Then take the amount of the breakage that was calculated in step 1 and multiply that by the percent that you got in step 2. And so when you do the math, you should get $29.49. So unearned revenue gift cards go down by $29.49, and we're going to call that breakage revenue. We're taking the assumption that 86% of the gift cards have been redeemed and also factoring in that 6% breakage. Okay, and we're labeling that or moving that amount from the liability to a revenue account, specifically breakage revenue. And then the last question, what is the end of year liability for gift cards if the liability for gift cards was $15,300 at the beginning of the year? So the beginning balance, it gives you that $15,300, additional gift card sales $57,150, subtract how many were redeemed, $46,400, subtract the breakage, the amount that we have labeled as breakage revenue, that those gift cards are lost. So the end of year balance is $23,101 remaining as our unearned revenue for gift cards.